Warsh was very direct in his press conference, saying that persistently high prices are a burden on the American people, and that this committee will deliver price stability. In other words, his priority is getting inflation back down to 2%, even if that means raising rates.
The good news is that the US and Iran have reached a provisional peace deal, and oil prices have already dropped more than 35% from their recent peak. But that drop hasn't shown up in the data yet, which is why a lot of analysts think May could mark the peak of this inflation cycle, with numbers potentially cooling off in the months ahead.
Hey everyone, there's a massive economic update coming out of the United States right now, and it's about to affect stock markets, loan rates, and investments worldwide. The Federal Reserve just held interest rates steady at their latest meeting, but the signal they sent has caught a lot of people off guard, because now the conversation isn't about rate cuts anymore, it's about rate hikes. In this video, we're going to break down 3 things: exactly what the Fed decided, why the inflation data is such a big deal right now, and most importantly, what this actually means for your money, your loans, and your investments. So stick around till the end, because I'll tell you exactly what to watch for over the next 6 months.
Let's start with what actually happened. On June 17, 2026, the Federal Reserve held its FOMC meeting. That's the committee that decides U.S. interest rates, and arguably the most powerful economic body in the world. At this meeting, the Fed kept its benchmark interest rate steady in the 3.50 to 3.75% range. No change. That makes it the 4th consecutive meeting with rates on hold. But here's the twist. This was the first meeting under new Fed Chair Kevin Warsh. And here's the part that really stood out. 9 Fed officials said they now expect at least 1 rate hike this year, not a cut. 6 of those 9 think there could be 2 hikes. That's a massive shift, because just a few months ago, everyone was expecting rate cuts. Now we're talking about hikes.
Now let's talk about why inflation has spiked so much. The inflation gauge the Fed watches most closely is called PCE, Personal Consumption Expenditures. The May data just came out, and here's what it showed. Headline PCE inflation came in at a 4.1% annual rate, the highest level since April 2023. Core PCE, which strips out food and energy, came in at 3.4%, the highest since October 2023. So why is inflation running this hot? The biggest driver is the conflict in the Middle East. When the Iran war escalated, it disrupted the Strait of Hormuz, a waterway that handles about 20% of the world's oil flow. That disruption pushed oil prices sharply higher, and when oil gets more expensive, it drives up the cost of transportation, manufacturing, and pretty much everything else. On top of that, service prices climbed too. Restaurants, hotels, auto repairs, and healthcare all saw price increases. Here's where it gets interesting. Wall Street itself is divided on what comes next. On one side, Bank of America is forecasting 3 rate hikes this year, in September, October, and December. Their reasoning is that this inflation problem isn't just about oil. Tariffs and other structural factors have made price pressures more widespread. On the other side, economists like New York Fed President John Williams believe inflation will ease on its own over the next few quarters, as oil prices stabilize and rent and shelter inflation continue to slow down. So the bottom line is, there's no consensus yet. Some expect hikes, others think the Fed will simply wait and watch. Now let's get to the part that matters most. What does this actually mean for your money? 1. Loans and mortgages. If the Fed raises rates, borrowing becomes more expensive. That means if you're planning to take out a mortgage, auto loan, or personal loan, rates could start climbing from here. And if you already have a loan with a variable rate, your payments could tick up as well. 2. The stock market. Higher interest rates are generally a headwind for stocks because borrowing gets more expensive for companies and investors often shift money into bonds, which start offering better returns. 3. Gold and safe haven assets. In times of uncertainty, investors often turn to gold and other safe haven assets. If you think volatility is coming, this might be a good time to think about diversifying your portfolio. 4. The US dollar.
If the Fed hikes rates, the dollar tends to strengthen, which can have ripple effects on currencies, trade, and import costs around the world. If you're involved in international trade or travel, this is worth keeping an eye on.
So, what should you be watching going forward? The biggest one is the next FOMC meeting in July, along with the monthly inflation reports leading up to it. If June's inflation numbers come in lower, that reduces the odds of a hike. If they stay hot, expectations for a September hike will likely increase. The second thing to watch is oil prices. Until the situation in the Middle East fully stabilizes, oil price swings are going to keep influencing the inflation outlook. I'll be tracking every major update right here, so make sure you subscribe to the channel so you don't miss anything.
U.S. President Donald Trump has said a deal to end the war with Iran would be signed on Sunday, and that the strategic Strait of Hormuz would be open to all immediately afterwards. At the same time, Trump kept the threat of fresh attacks dangling if the deal failed to pan out as expected. Markets are likely to remain highly sensitive to developments surrounding the proposed U.S.-Iran agreement, Panmudi R., CEO in Rich Money, an online trading and wealth tech firm, said. Meanwhile, foreign investors remained sellers in Indian equities, dumping more than 62,853 crore of shares in the first fortnight of June. With the latest outflows, total withdrawals by foreign portfolio investors, FPIs, from Indian equities have surged to 2.87 lakh crore so far in 2026, surpassing the 1.66 lakh crore pulled out during the entire calendar year 2025, according to data from the National Securities Depository Limited, NSDL. Pravesh Gore, senior technical analyst at Swastika Investmart Limited, said on the domestic front, the progress of the monsoon season and inflation trends will remain key areas of focus. Another major event on investors' radar is the upcoming Federal Open Market Committee, FOMC, meeting, scheduled for June 16-17, 2026. Market participants will closely monitor the Fed's commentary, inflation outlook, economic growth projections, and indications regarding future rate cuts, he added. Last week, the BSE benchmark Sensex jumped 1,284.61 points, or 1.73%, and the NSE Nifty surged 256.2 points, or 1%.
So that's the complete breakdown. The Fed held rates steady, inflation is at a 3-year high, and the conversation has shifted from rate cuts to rate hikes. If you found this video helpful, hit like, subscribe to the channel, and let me know in the comments. Do you think the Fed will raise rates this year or not? I'll see you in the next video. Until then, manage your money and your investments wisely. Thanks for watching.